I always share with my participants and investors that life and equity investing are highly correlated. Investing teaches us a lot about life. In this video, I'll share the lessons I learned from my 15 plus years of investing journey. And while I share that, take a note of how closely related these lessons are with the kind of qualities one may have in life. Hi investors and welcome to the video. Let me start with the first and the most important learning which I have experienced in these 15 plus years, and that is stock investing is just 1% information and 99% temperament. Now what do I mean by that? You must have seen everyone around you, maybe including yourself, running behind information, running behind those tips. You just need that one information or tip or the name of the stock or name of the mutual fund scheme which will make you maybe a crorepati and turn your fortune, right? We are all running behind information. The problem is, even if you have the right information, it is your temperament which will determine whether you really make money out of it or not. Because having information is one thing, but being able to use that information with wisdom is another thing, right? Now, how do you gain that? How do you work on this temperament? In my experience, when you're reading something, let's say you're reading a newspaper or journals, or you're watching TV or reading a report, all that will give you information, which is important. You see, 1% information is still important, but that's like the foundation. But when you read books, that's what gives you the wisdom and the temperament to use that information in the right manner. So in my opinion, the best way, or maybe the only way to keep on working on your temperament is developing this habit of reading books. So please experience this maybe over the years, or maybe learn from others' experience, that what you have to really focus on is not just information, but much more than that, on how to keep your temperament. For example, when the market is up or it is down or it is very volatile, how do you behave? How do you react? How do you respond? Yeah. So that's what determines what your temperament is, right? So that's lesson number one. Lesson number two, higher the risk, higher the return is a myth. And I don't know how many people have lost crores and lakhs and how much of money just by this one misconception that if I invest in high risk stocks, or if I do high risk investing, I will get high returns. That's not true at all. See, if you're comparing FD with stock market, it's understandable. Okay, fine, FD is like safe, stock market is risky, that's why it's giving you more returns. But once you enter into stock market, within that, it is not higher the risk, higher the return. Within that, whatever ocean of stocks you have got, it is actually lower the risk, higher the return. Stop running after those high risk stocks in the hope that you will make high returns. In fact, high risk is equal to high loss. And why would you want to make a loss? Right? Let me tell you a story to explain this very simple concept. Let's say you and I both decide to buy a piece of property, and let's say our budget is say 30 to 40 lakhs, and we are planning to buy some plot of land in the outskirts of the city. And the purpose of this investment, this thing is only investment. It's not for end use. Yeah. So we're talking pure investments. Now, you believe in research. So what you do is, you first take out the master plan of the city, you see which area the development is expected to happen, you read a lot of news articles and get information from your known people, and you pinpoint one area in the city that this is maybe, let's say, the south of the city. You want to go in the outskirts and invest in a property. Now, in that area, you look for which developers are coming up with projects. You shortlist, let's say, 6 to 7 developers who have their projects or who are coming up with the projects. Now, you start doing the analysis of how good these developers are in terms of what kind of projects they have done, have they delivered timely or not, have they fulfilled their promises or not in the past, and based on that, you, let's say, come down to 3 developers, or let's say 2 or 3 developers or 2 or 3 projects. Now, beyond that, you go and visit that area, you see what is the development happening right now, what are the kind of rates in the nearby townships, is the developer, the 2 or 3 projects you have shortlisted, are they coming at a competitive price or not, right? So based on that survey which you do, and maybe you take help from your friends and your relatives and neighbors, and you talk to people around you, and you get to know that these two projects maybe are better than the third one, or these two are the final two projects you really want to focus on. Now you take papers from the developer and get it vetted by a lawyer, right? So you make sure that the property is legal and everything is fine in terms of legality of the property. Further, you do investigation on the location of the property and the growth aspects and all those things, and you pinpoint one project which you really want to invest into, right? After all the research you can do, you pinpoint one project. Now you go there and you sit with the sales team and you listen to their very attractive sales presentation. Now, because you have done your research, you are able to ask them relevant questions, and thankfully they end up convincing you that whatever they are saying, because you have done your research and you could ask those questions, you got the answers, and you are convinced you want to invest in this project. You are still not done. Now you call the Vastu expert, and based on his analysis and suggestion, you end up buying, let's say, plot number A22, a certain dimension and certain size. So you have decided this plot after all this research which I talked about. Now comes me. Now I believe in higher the risk, higher the return. And I have my previous experience to prove that I want to just invest in high risk investment. That's what will make me get high returns. So I read this newspaper advertisement, which was like a full page ad of this project on one Sunday. And I was anyway planning to buy a property. So I visit their project, listen to the sales pitch, very attractive sales pitch. I get convinced and I cut the booking check and I buy a plot number A21, same dimension, same size, same direction, same road, same price, same everything as what you have bought. 10 years down the line, both of us sell the property and we both make good returns. So same property, same location, same everything is same. So if you are making returns, even I am making returns, right? Now, in this scenario, in this story, in my view, I took high risk. Why? Because I hardly did any research. I just went there. I had some intuition or some gut feeling or my notion that I have to take that plunge. I don't have to think too much. I have to take high risk. So I went with that project and I made my money. And for me, it was a high risk investment. But for you, it was actually a low risk investment. Why? Because the level of your knowledge was very high. So the actual theory which works in the stock market is higher the knowledge, lower the risk, and thereby higher the return. It is not higher the risk, higher the return. It is higher the knowledge, lower the risk, and higher the return. And you can do this analysis of the stocks which have done well in last 10, 20, 30 years. You will find that those stocks were never high risk stocks. Exceptions can be there, but 99.99% of the time you will find that the stocks which have done well were actually low risk stocks. Why? Because if you do the research in those companies, you would have realized they are actually fundamentally sound stocks, fundamentally sound businesses. And that's why they gave you returns. Lesson number 3, context of doing stock investing is you are investing in businesses, not stocks. Understand, you are not going to some casino and buying some chips. You are buying businesses. Let's say you buy Reliance, there is a business behind Reliance. You buy Airtel, there is a business behind Airtel. You buy Eicher Motors, there is a business behind Eicher Motors. So you become a business person the moment you enter into stock market. Whether you are doing a job or a business in your professional life, that's a different thing. But when you enter into stock market, you definitely become a business person. So please start thinking like one. This is the context of stock investing, that you are investing in businesses. And I have learned that context is decisive. So please ensure that you please work around your training your brain to think like that you are buying a business and you are selling a business. Now, a lot of things will change just because of this one thought process. Because the moment you think like that, you will not do buying and selling every day, every week, or even every month. Because that's not something you do in business, right? You will not just buy anything. Because that's not the way you start a business. You will not sell something because temporarily there is a problem, because that's not the way you shut the business, right? So just this one thought process will transform the way you think, and it will transform your complete portfolio and also the end result which you will get from in terms of the returns. So that's lesson number 3. Lesson number 4, it is okay to lose opportunities and it is okay to make mistakes. Now, stock market is actually a place of regret. You do not buy a stock and it goes up, you regret, why didn't I buy it? You buy a stock, it goes down, you again regret, why did I buy it? Right? You buy some stock, it goes up, you still regret, why did not I buy more? Right? So there is always an opportunity you have got to regret. But please stop doing that, because that will make you a speculator rather than an investor. It is okay to lose opportunities. And the good news is, look at the portfolios of all the successful investors in the world. They have lost not 1, 2, 5, 10. They have lost tens and hundreds of opportunities. Still, they are super rich. And that's a good news. So even after losing so many opportunities, they are still rich. Right? You look up to them. Look at Warren Buffett's portfolio. Look at maybe Benjamin Graham, Philip Fisher, Peter Lynch, Rakesh Jhunjhunwala, Vijay Kedia, anyone. Do you think they have got the best 20 stocks in their portfolio? I'm sure there are minimum 300 to 500 stocks in which they have not invested and they have given higher returns than the best stock in their portfolio. That's the kind of opportunities they have lost. Still they are super rich. Right? And within this, it is okay to make mistakes. That is, to invest in stocks and later learn that it is a mistake to invest in this stock and if you have lost money in that company. That's fine. Again, look at these successful investors. 2 to 3 out of every 10 stocks they invest into, they make losses. They are still super rich. Isn't that a good news again? So please be easy on yourself. It is okay to lose opportunities. It is okay to make mistakes, because even after doing that, you will fulfill all your financial goals and you will create wealth. But you have to get out of this thought process that you have to, latch on to every opportunity, or you should not make mistake, or you should not lose money here and there. You will lose money here and there. That's fine. Yeah. So be calm with that. Lesson number 5, and I believe the most important lesson, that is starting early, is crucial. Investing has always been about how early you start and how long you stay invested. And no matter how much you agree or believe in this, agreeing to something and implementing something are two different ball games, right? So you might be agreeing to it, but have you really started investing? And are you staying invested after that? Look at that, right? It's more about building the habit of starting and staying invested. That's what will make a difference to your portfolio once you are, like, let's say you cover 15-20 years of a journey, right? If you start in 45, 50, 55 of age, then 15 years looks a very long time. But if you start, let's say, very early, from the very first paycheck, that's what I did. I started from my very first paycheck. I didn't even get to know how these 15 years passed by. And that's exactly what has helped me to become financially free, right? So these 5 investing lessons is something which has been at the core of my thought process, which has helped me to take my portfolio to a level which was not possible otherwise. It's not about how much I've invested. It's more about following a thought process and being clear about what you are doing and why you are doing. Yeah. I hope these 5 lessons will help you take those appropriate calls in your investing journey, and it will help you achieve all the financial goals. Thank you so much.